Hello everyone and welcome back. In this video I want to talk about Intuitive Surgical because they just reported earnings. The stock is up 3% on a pre-market level. This is a quality company that I've been following for a while. So in this video I want to make a quick update how the situation is evolving, how this quality premium business is still becoming quality and premium, and maybe how everything will accelerate thanks to AI. We'll talk about the valuation, we'll talk about the report, and we'll talk about whether I'm buying the stock right now or not. Okay, and if not, what is a good target price for buying? In case this is your first video from this channel, welcome. My name is Christophe Noor. I'm French. I've been investing in the stock market for almost a decade now, and I have achieved a performance of roughly 25% per year. And I only invest in quality companies, and I've been following plenty of companies. One of them is Intuitive Surgical. In terms of moat, we are almost exemplary. For those who don't know this company, I'm on Guru Focus right now. I can read the description. Basically, they make robotic arms for surgeons, for surgical operations. Basically, this is what they do. Intuitive develops, produces, and markets a robotic system for assisting minimally invasive surgery. It also provides the instrumentation, disposable accessories, and warranty services for the system. The company has placed more than 10,000 Da Vinci systems, this is their robotic arm, in hospitals worldwide, with more than 6,000 installations in the US and a growing number in emerging markets. Very simple. I mean, they are in a niche market and they are the best. So maybe this is a pure play, pure monopoly. The company is big. You have almost $200 billion of market cap. You have gross margins of 65%, net margins of 30%. I mean, it seems like a software company, right? We are talking about an extremely well-run business model, very, very profitable. The revenue is up and to the right. The net income is up and to the right. The company has no debt. They are filled with cash. The free cash flow is improving. The free cash flow is a little bit more volatile because the company has some capex. But anyway, we are talking about a very efficient business model, and the ROIC is 20%. The ROIC is the return on invested capital. It's a measure for efficiency, and it's 20% and consistent at 20% per year. So they can reinvest in the business and generate 20% on their returns. No meaningful buybacks, no meaningful dilution. The company is filled with cash, and they just reported earnings. The report, let me first tell you, it's pretty good. If you go to Fiscal AI, you can click on Investor Relations and the report. You can click on this AI summary, which is a great tool that you can use on Fiscal AI. By the way, you can use my discount code in the description to use Fiscal AI and get it cheaper. Basically, everything is on track. Everything is fine. The business is in a very good shape. The revenue is growing 20%. The net income is growing. The cash pile is still increasing, and everything is reaccelerating. They are selling more robots. They are increasing their installed base. You have a lot of growth, a little bit everywhere. The installed base is growing 12% per year. The guidance is still fine. They are guiding for a growth rate of double digits, and everything is in good shape. And if you scroll through the report, you will see only good news. Everything is growing double digits. Everything is safe. Everything is pretty sound. Now you can navigate through Fiscal AI. Look at the revenue percentage, the revenue growth rate. This is the blue line you have here for the past decade. For the past decade, the company has been growing at double digits. The revenue went down during 2020, but even if you take into account 2020, the revenue growth rate has been 16% per year on average for the past decade. And the median has been, 15-16%. So basically, a business in a great shape, and now the guidance is also double digits. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. Now, if you go into more granularity, you can click on segments and KPIs. You see that the business has different segments: the product and the services. Inside the product, you have instruments and accessories and systems. you can check what is the growth rate for these two segments inside the product segment. You can see that the blue line, the most important line, the biggest segment, instrument accessories, growing 17%, and the sim stems growing 20% per year. Everything is in a great shape. Everything is growing roughly 18-19% per year. You have a total product revenue growth rate of 18% right now. The other line is services. Services is in orange. The services growth is 21% per year. So the services segment is reaccelerating. It went from 10% growth rate to 21% growth rate. So actually, the company has this split of revenue, and you can have the gross profits of each segment, the product gross profit and the services gross profit. So thanks to Fiscal AI, you can calculate the gross margins for each segment. And I can show you how to do it in this video. You can go to custom metric here, create a custom metric, and you can click on percentage, so gross margins for product here. You can check product gross profits divided by product revenue. Okay, this should get your gross margins for products. Okay, and we can create the other one called gross margin for services. You can have the services gross profit divided by the services revenue. Services revenue. Now you have the margin profile, the gross margins for each segment. The blue line, the gross margins for products, and in orange, the gross margins for services. You can see that these two lines are fluctuating, but roughly speaking, we are at 65-70%. I can check the average for both lines, 68%, 67%. So don't get too excited because of all these fluctuations. We are fluctuating, but in a very narrow range, 65-70%. What I want to say is the business was very profitable 10 years ago. The business was very profitable 5 years ago. The business is very profitable now. I don't expect margins to skyrocket in the future, even though that's a possibility. But I don't expect the margins to go down significantly in the future. You will have fluctuations, but roughly speaking, we are talking about a very, very profitable business. Now you can also check the overall gross margins of the business. You will see that these gross margins are just disgustingly high. And operating margins are also stable. We are talking about operating margins that went from 35% to 30%, they say at 30% basically. So that tells you a lot about the moat. If after 10 years, the margins are still the same. Literally, the profitability of the business has not changed in 10 years. That could mean that competitors are not coming to eat your lunch. That could mean that the moat of the business is still intact. And if you go through the cash flow statement, you want to check the net income, the operating cash flow, etc., etc., you will see that the company has a lot of conversion between operating cash flows and net income, and the company has some capex. As you can see here, over the past few years, the capex line has increased. Something to monitor in the future for those who want to go deeper in the analysis. They invested in-house very recently, 2022, 2023, and now the capex line is shrinking again. Maybe it was a one-off event, and 2023 was a capex reinvestment year, and now the business is going to be asset light again. Anyway, something to monitor. If you take into account the capex expansion recently, you can see the free cash flow over time. Here is your free cash flow growth rate over time. Maybe it will be biased because of this big capex. So the free cash flow went down a lot for 1 quarter and rebounded a lot for 1 quarter. if you play around with some numbers, if you put an average, yeah, you have an average of 53%. So let me remove this. Okay, that's better. I like it better. For the past decade, almost the past decade, the free cash flow of this business has been growing at 20% per year. Something that can be quite useful if you want to forecast the future free cash flow growth, it would be to forecast the operating cash flow growth. That could be a little bit better because you don't have to make this big adjustment. Fair enough. Over the past decade, the operating cash flows of the business have grown at 25% per year. So this is a business that can grow double digits, 15%, 20%, 25% per year, and they can keep doing this with a lot of efficiency. If I go through capital efficiency here and I check the return on invested capital, let me put annually, it will be better. This is what we have. For the past 2 decades, we have a ROIC, which is maybe my favorite measure of efficiency, that never went below 15%. As always, yes, it is fluctuating. It depends on the profitability, but it ranges between 15% and 30%. How good do you want your ROIC to be? Like the minimum is literally 15%. It's wonderful. So the average should be roughly 20%. Basically, a business in a monopolistic position that can grow double digits in an industry that is growing, robotics for surgery, this is literally the future. They have sustained a very high margin profile for many years. They are guiding for double-digit growth. They have always been efficient, always had a ROIC that is minimum 15% per year. What kind of valuation do you want for this business? I have 2 metrics for you. The forward PE ratio in orange and the forward price to free cash flow in blue. You can see that these 2 lines are roughly similar. You have a free cash flow conversion that is great. In the past, the company was always trading at a premium. Even if you look at the low valuation in the past, the lowest valuation we had was a forward PE ratio of 25, like the lowest, and a forward price to free cash flow of 28. And then after COVID, you had some small declines in valuations, but to be frank, the valuation was always high. The low point we had in 2022 was a forward price to free cash flow of 36. I mean, it's like Hermes, luxury companies, they never got the low valuation. They are never trading at an attractive price because everybody knows they have a moat, everybody knows they have a long runway, and everybody knows they are very well positioned to benefit from an AI world right now. If you go to Fiscal AI, I can show you this. This is the DaVinci Systems installed base. Basically, this line is up and to the right. Over the past few years, they are just delivering more and more and more. And if you grow your install base, you grow your services revenue. So you have a beautiful flywheel of a business. And because of this beautiful flywheel, you have sustainability, visibility of revenue. And similarly to plenty of recurring businesses, they deserve a premium because of the quality of the revenue. It's not a cyclical business. It's not a business that can go bankrupt because they are filled with debt. Literally, they have no debt. So maybe they deserve a premium valuation. The next question is, do they really deserve a price to free cash flow of 50 right now and a forward PE ratio of 56? For my portfolio, no. I would love to buy Intuitive Surgical because the moat is just wonderful, but the valuation is just too high for me. So I am monitoring Intuitive Surgical in case there is a problem, but for the moment the price is too high. If you use a DCF and you want to find a good target price, you can go to Stock Unlock. This is the best investing website I have when it comes to DCF models. I have a discount code in my description also if you want to use it. This is the best DCF. If you need one DCF model, one intrinsic value model, this is this one. So please use this one. If you want to forecast the earnings of the business, for the past 5 years, the net income has grown at 21% per year. This is something that can be done, by the way. So if your assumption is that earnings will continue to grow at 20% per year. And the business is of quality, so they deserve a PE ratio of, let's say, 30. We are being conservative. The last time we had a PE ratio of 30 was back in the days, like maybe 10 years ago. But let's say we have a valuation PE ratio of 30. And you don't expect any dilution, any growth in dividends, this is fine. If these are your estimates, then the stock right now is 30% overvalued. And if you buy it right now, today, you will have a performance of 1% per year. So the fair value is $350 per share. Now the stock price is $550 per share. So the stock is overvalued by a lot. If you play around with some valuation numbers, if you say on the high end, it deserves a premium valuation, a PE ratio of 35. If you're being bullish, then the stock is still overvalued by 20%. If you buy today, you can expect a CAGR of 4% per year, CAGR compound annual growth rate of 4% per year, and the fair value is $400. We are still overvalued. So this could be a good target price for me, something below $400. In the meantime, I'm just monitoring the situation. And actually, Intuitive Surgical reminds me of another business that is also of very high quality, and I don't think I've talked about this business in the past, or maybe very shortly. This is ProMedicus. Same industry, same vibe, but in Australia. So ProMedicus is a company that is not well known, not well covered online, very niche, but I will scroll down on Guru Focus right now. You will see the charts and you will love it. So let me read the description. You clicked on this video to know more about Intuitive Surgical, to have an update. Well, nothing really new. Frankly, the report was just great. The guidance was great. The business model is great as usual. But I will give you a bonus because to thank you for clicking on my video, because I want to talk about ProMedicus. It's a healthcare IT company specializing in radiology imaging software. Its main product, Visage 7, is a clinical desktop application that radiologists use to view, enhance, and manipulate images from any device and make a diagnosis. So basically, its main customers are US private academic hospitals, and you have recurring revenues. You have like a cloud storage of all the work you have on the radiology system. This is a recurring business model. The company is from Australia in a niche market, but it works beautifully. Gross margins extremely high, more than 90%. Net margins of 50%. Operating margins of 70%. Like, this is one of the most profitable business on earth. If you look at the revenue, look at this, up and to the right. Exponential growth when it comes to revenue. Net income, same thing. The company has no debt. Look at the exponential curve for cash. This is 10 out of 10. Wonderful. The operating cash flow, as you can see here, up and to the right. Exponential curve. The free cash flow, up and to the right. The efficiency, the ROIC, it's just increasing and increasing and increasing. In the past, the company had some small dilution of shares. Now it's minimal, negligible. But a thing that I hate to see is the valuation. The PE ratio is 160. The forward PE ratio is 120. The price to free cash flow is 180. Keep in mind that the stock is down. Now the stock is down 46% below highs. And even if you cut the business in half, the PE ratio is still above 100. Everybody knows it's a quality business. Everybody knows the moat of this business. But it's the kind of company I would love to have in my portfolio. See, it reminds me of Intuitive Surgical. I see these two companies are as very similar because they operate in a niche market. They are very well run. The revenue growth is immense. The moat is very wide, but the valuation is very high. So I'm monitoring these two situations. I am not invested in these two companies, and I want to be a shareholder. So I hope for them that they drop in price so I can finally buy. But Intuitive Surgical is in a very great shape right now. Very, very good shape in the future. I'm not touching it. It was just a small video for an update, something I have on my watch list and I want to buy in the future. but the company is still amazingly well run and it's a great buy for the future, but not now. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.